Kia ora, morena everyone, and welcome to the Responsible Investment Consumer Study launch for 2022. From Values to Riches, Charting Consumer Demand for Responsible Investing in Aotearoa New Zealand, published by RIA and Mindful Money. Tēnā koutou, tēnā koutou, tēnā koutou katoa. No whakatū aho, ko higiti te whānau, ko Dean aho, ka nui te mehe, kia katoa, tēnā koutou, tēnā koutou, tēnā koutou katoa. I'm Dean Hegarty, and for those of you who I haven't yet met, I'm the Executive Manager of Membership and Engagement at RIA, and it gives me great pleasure to host you this morning. We have a fantastic session lined up for you. We're first going to hear from the study's authors, who will deliver an overview of the key findings from the report, which will then be followed by a panel discussion with the chance for some Q&A. As we go along, please feel free to place your questions into the chat function, and we'll endeavour to get through as many of those as we can throughout the discussion. So without further ado, I'd like to warmly introduce you to two of the report's co-authors. Firstly, Barry Coates. Barry, who I'm sure many of you know, is the founder and CEO of Mindful Money, a New Zealand charity that aims to channel investment towards high social and environmental standards and positive impact. Mindful Money focuses on engaging and empowering public audiences, including providing transparency on investment portfolios, public education through weekly online seminars, and annual ethical and impact investment awards. And I'd also like to introduce Zsuzsa Benhalmi-Zakar, who is the Manager of Research Programs at RIA. Zsuzsa has an extensive track record as a researcher, spending the last 9 years in academia. During that time, she has completed a PhD in sustainable finance and has worked extensively with investors and the not-for-profit sector within the region. Zsuzsa, I'll hand over to you to begin our look into the findings.
Thank you, Dean. Good morning, kia ora, everyone. It's lovely that you're able to join us, and I'm really excited to share with you the results of our latest study. So first off, I wanted to shed light on the purpose of the study and its history. So the purpose of the New Zealand Consumer Study is to establish and track consumer awareness, practices, and attitudes towards ethical and responsible investments in New Zealand. We also do a similar study in Australia, or basically the exact methodology. In the past in New Zealand, we have published reports in 2017, 2018, and 2020. So there is some opportunity for trend analysis and to track some of the changes, as well as in 2016. So there is a long history there with consumer awareness tracking. So about the study, so our research partner is Dynata, and we work together with Mindful Money both to develop the survey, which was an online survey, as well as discuss the results, identify the key findings, and write the report together. We had total respondents of over 1,000 people this year. And the way that that these individuals were collected was that, their response was collected is that they're representative across age, gender, and region. So what you see in the graphs below is that we had just about an even split between men and women. We also attracted some minimal responses from people who identified as non-binary. Because of that small proportion of non-binary, most of the report's findings are actually portrayed just in the binary, because there was just not enough in our sample to be able to make conclusive analysis, I guess, and findings on the non-binary data. So going back, sorry, so in the middle we have the regional breakdown. So we've got the proportion of the total sampled population and their distribution and the various regions. And on the right-hand side on that graph is the breakdown with generation. So this was another key point. We definitely wanted to capture the generational, if there are any generational trends. So we've got Gen Z, Those are aged 18 to 24, the millennials aged 25 to 39, Gen X from aged 40 to 59, and the baby boomers were everybody above 60 years of age. The data was collected, like I said, by Dynata online between the end of January 27th and 7th February, so relatively short period. Next slide, thanks. So one of the first questions that we ask in our survey, of course, is whether the respondents are aware of what responsible or ethical investing is. And what we see is that this year that we had a huge growth compared to 2 years ago. So almost half of the population said they knew what responsible or ethical investing means. So that's a growth of 13 percentage points from 2 years ago. The graph that I have up there, however, is not the total from 2020 to 2022, which is in the report, but the generational split. And I thought that that was quite interesting because as I analyzed the results and have gone through, I realized that there is a real story here with the different generations. And you'll see that as we go through the report with Barry, with some of the key findings that will return to that theme. So what we see here is that Gen Z is the least knowledgeable, whereas Gen X and baby boomers claim to be the most knowledgeable. So their awareness and their knowledge is quite high. So just bear that in mind as I think as we go through some of the other results as what this means. Next slide, please. So then we asked about expectations, and what we find is that almost 3/4 of Kiwis expect their investments to be ethical or responsible. Now, the emphasis here is on the expectation. So it's not that they would necessarily ask that their funds are invested responsibly or ethically. There's a difference in there. They expect their money to be invested responsibly or ethically. 80% of women, so women are much more likely to claim that they expect their money to be invested responsibly or ethically compared to men. And again, I have the generational split graph there. So you see that actually it's fairly even between the generations. The expectations are equally high, yet Gen Z is the highest. So their expectation that their money is invested in this way is quite high, whereas baby boomers' expectations are a little bit lower there. Next up. So what happens if those expectations aren't met? Well, then we ask people if they're willing to switch to another fund. And more than half of Kiwis said that they would consider moving their money if they found out that their current fund invested in companies that engage in activities not consistent with their values. So that's a pretty strong message, particularly when Barry gets into some of the barriers as well as to why people aren't investing responsibly. But really, basically what this means, if they do find out, whether through media or their own accounts, that they are willing to be looking for those funds that will align with their values. Again, I have the generational split there for you. So we see that millennials are the most likely, followed by Gen Z, to make that switch. And I think in terms of, if we're looking at KiwiSaver and their ages, I think that's a pretty compelling story there, that the younger generation is ready to act on their values, I guess, when it comes to investments. Next up. So a big story from the report is the concern around greenwashing. And I guess it's no surprise when you have a larger proportion of the population expecting responsible or ethical investment, then obviously their concerns around greenwashing will also rise. Also, the awareness has grown around responsible investment. So all of this is fueling this increased focus on greenwashing. And what we find here is that half the population is concerned about greenwashing, which we would loosely define that as misleading claims that the investments are making social and environmental benefits, and they're achieving those outcomes. Coupled with that, we asked if they would be more likely, or how likely would they be to invest in a fund that is independently labeled or verified as ethical or responsible. And we see again that over half of the population would be more likely to invest in a scheme like that. So the graph on the right is really just portrays the answers to those two questions that we asked there. So in the green, we see that the concern figure, that I'm concerned that ethical and responsible investors engage in greenwashing. And the blue shows that I would be more likely to invest in a certified or labeled fund. So again, we see much more prominent expression, I guess, of values around from the generations that Gen Z and the millennials, and sort of decreasing with age there. So I think that was it from me, and Barry's up next.
Kia ora, ngā mihi nui kia koutou, ka Barry Coates ahoa ka te kārahi o Patea Whai Whakaaro. Hi everybody, I'm Barry Coates, CEO of Mindful Money. So it's wonderful to be here, and it's good to be running through this survey. I'm going to talk about the question related to what people wanted to avoid in their investments. And one of the things we've found over the four surveys has been the consistency in these factors. So up the top, we have human rights violations. 90% of people want to avoid investments in those. Then labor rights abuses, environmental damage, violations of the rights of Indigenous peoples. Those kind of, the violations of the rights of Indigenous peoples is a new issue that we included this year. But the other factors, and many of those below, have been remarkably consistent from year to year. And in a way, it's kind of a validation that these are some of the shared concerns. Because often people say, well, you know, ethics are individual. But yes, they are, but there are also a number of ethics that are held very strongly in common across the population. And the other thing to observe is that these are very high values compared to some other countries. So, for example, when RIA's survey on the Australian market looked at these kind of factors, the overall level was far lower. And just to say one other issue is that these, unlike many other issues in the survey, these are particularly strongly held by older people. And so, you know, the picture is that these concerns are kind of particularly concerns for baby boomers and perhaps not so much these days for millennials and Gen Z. But certainly for older generations. And I think this is one of the areas where people say, well, you know, responsible and ethical investment is driven by young people. Well, actually, there's also, it's bimodal. There's a very strong interest and commitment also from the older generation. So let's move into one of these issues, which is issues of animal welfare. Now, this is something particularly important to younger people, but, you know, unsurprisingly, it's also important to across the generations. We asked 3 questions around products tested on animals, animals kept in cages and crates, and animal products. Animal products was a recategorization. Previously, we had asked about avoiding meat and meat products. But this time we asked about animal products. The outcomes, as you can see, are extremely high. People want to avoid animal welfare issues. And it's interesting because there are very few funds in New Zealand that offer exclusions on these issues. And we've seen, for example, 2 funds with 2 providers with exclusions on products tested on animals and some exclusions on essentially factory farming or animals kept in cages and crates. However, we haven't seen, on the bottom one, we haven't seen any vegan funds for diversified funds. And so the 73% of people who are concerned about animal products essentially are looking around for a fund, and there are some opportunities there for providers to be able to tap into some of these market segments, which aren't fully catered for at the moment. If we move to the barriers to investing ethically, for most people, these have been remarkably stable again over previous surveys. Lack of independent information and lack of time available to consider the options and compare them. So in a way, that's one of the sort of founding rationale for mindful money in terms of providing that transparency, and also in terms of RIA's provision of information through their responsible returns tool. So as organizations doing these surveys, we're interested to see this demand for information. And there's also further information in this survey around what people expect. They expect to know what companies they invest in, and that's not routinely provided by providers. And they want to know the real world outcomes of their investments. So, these are the kind of things that people want, but they're not always catered for in terms of providing that level of independent information, and certainly not available on a comparative basis, other than through mindful money and RIA. The next one is the positive side of the story, what people really want to invest in. And I think we're seeing a change in the market where people do want to avoid things, but they also want to invest in good outcomes. And I think this is a maturing of the New Zealand market, and I think it's exciting because we're now starting to see more funds shifting into providing at least part of mainstream portfolios in the positive outcome space in terms of impact investment. So this is important, and one of the key findings here is 53% of people say they'd be motivated to save more if they know their savings make a positive difference. Now that's quite remarkable in terms of public policy, because we have so many policy instruments that are out there trying to get people to save more, but very rarely do they talk about people's interest in their investments actually doing good in society. So I think this is a sort of a rationale, not only for funds to respond to this demand, but also for public policy to recognize that investing positively has a benefit on savings rates as well as the positive outcomes in social and environmental issues. So 62% of New Zealanders say it's important that their investment makes a positive difference in the world. What we see is that people say that this kind of investment and impact is important, of course, where the returns are as high, and that's around 50% of the population. But we also see a number of people saying they'd be prepared to invest in positive outcomes, even if the investment returns aren't as high. So this is important, as are the kind of issues that people want to invest in. This slide shows a lot of detail on those. I just say the top ones: healthcare and public health, healthy rivers, sustainable water management, renewable energy. These factors, again, have been very stable in recent years, with healthcare and public health having moved up during the COVID crisis. But the other issues have been there and have also been important. And on climate change, we find that half of New Zealanders want their funds to reduce emissions, and a similar proportion to go to net zero. We have found that the lowest commitment to those is in the group of male baby boomers, which perhaps is not too much of a surprise, given climate change. Should we say hesitancy around older males in New Zealand. So if we move on to the next slide, the outlook is strong. So ethical investment continues to rise. We've seen over the years, dramatic rises in the market for ethical investment. We've seen a huge number of new offerings from funds, and that is set to continue. And the study kind of shows that this demand is likely to continue for quite some time. So of those who don't have a fund, 2/3 are considering getting an ethical fund, 35% next year, a further 30% in the next 1 to 5 years. So that shows that we can expect further rise in future in demand. So it's a positive step for those who are considering offering more ethical and impact investment products. So I'll hand back to you, Dean.
Wonderful. Thank you, Barry. And thank you to Juja as well. And well done on compiling such an insightful report. I'd like to now open the discussion up. And so we'll be taking questions through the Q&A function, as well as what's going on in the chat as well. I'd like to ask RIA's CEO, Simon O'Connor, to join us now as well. Simon, for those of you who don't know, has been CEO of RIA for 9 years and works across the region and internationally in responsible investment and sustainable finance initiatives. Amongst many other things, he is currently the chair of the Global Sustainable Investment Alliance and a member of the National Advisory Board on Impact Investing within Aotearoa New Zealand. So the first question I'd like to hear from each of you, but if we could start with Simon, what stood out most to you in this year's responses?
Well, kia ora all. Thanks, Dean, and thanks, Juja and Barry. It's always really important and great working with Mindful Money on this research, because I think there's a lot of really rich data that's so important for our members and our industry. But there's a really good story here, and there's a really clear warning for us here, is sort of my view. The good story is we're seeing this really big step up in awareness and in appetite and interest from New Zealanders to really align their ethics and their values with their investments, with their banks, with their KiwiSaver, and I think that's grown rapidly. The propensity the desire to move is growing rapidly, and we're starting to see that translate into action, whereby funds are moving, money is moving, and we're seeing that on a number of measures. But I think the warning here is that as consumers become more attuned to this, and rightly so, they're scrutinizing more closely, they're expecting higher accountability to claims, they're wanting to actually understand, they want to cut through just the marketing around products and understand what's really going on, and making sure, in fact, that these funds are delivering in line with the ethics and preferably are delivering positive outcomes on sustainability measures. And so I think as an industry, we need to be responsive to that and really be stepping up on the transparency and clarity by which we're talking about our products, describing our products, and really look at this data to inform how we're shaping up the products we have on offer. So a really good story of momentum there, but also really clear warning for us as a sector that we need to be really clear and transparent and accurate, and ensure we're actually providing what our beneficiaries want.
Thanks, Simon. Barry, did you have thoughts on that?
Yeah, I think Simon's described it really well. Another sort of big outcome for me is a shift of the market. People really strongly want to avoid things, but this appetite for more products, more investment funds that make a positive difference, I think is a really important dynamic in the market. And it's not just the niche impact investment products which are starting to become available to consumers. It's actually looking for impact investments within the mainstream funds. And we've seen a number of examples of those over the last couple of years. For example, a number of funds now supporting social housing projects. We've seen investment in renewable energy on a larger scale. So we're starting to see those examples. And it's about connecting consumers with aspiration. And I think if people can feel really good about their investments, we're going to see a whole new dynamic in the market. And I think actually that's going to drive even faster growth in future, because yes, people want to have funds that are aligned with their values and avoid bad stuff. But, they really get enthusiastic when they can invest in stuff that they feel really good about. It's like brand love. to be able to say, I'm really pleased with my fund. It invests in these things that I really care about.
And Barry, if I can, that was really staggering standout for me as well, actually, that propensity of this to actually engage consumers to save more, to actually improve their financial well-being was incredibly strong finding when we think about how important it is to engage people in their savings and improving their financial well-being. And that was the one chart that I saw there where the young people were even more heavily motivated to save more if they knew their funds were making a difference in the world. And these are the people we need to start saving to think for that long-term future. The 75% of the Gen Zs versus sort of an average of 50% across the board would save more, which is really important, as you've said, as a public policy issue for us to consider as New Zealand more broadly, in fact.
Yeah, I would say there's one other public policy issue that is often a little bit of a myth. I mentioned that this is bimodal, that baby boomers are also sort of strongly behind ethical investment. The other public policy issue is that there's often a perception that you only invest ethically if you've got discretionary funds to do it. And the survey doesn't say that. The survey says that even if you're a low-income investor, if you haven't got much to invest, you still want your investments to be ethical. And we often see, for example, financial literacy programs out there that don't talk at all about ethical investment. But if we're seeing that people want to get engaged in climate change, want to get engaged in sustainability issues and affordable housing and so on, that actually one of the ways to get people to care about their savings, to be able to save more, as this data says, is actually to engage people of all levels of income and savings with where their money goes, because it's important. And at the moment, most people don't ask the question and they don't think about it. When they do, then it can be a positive motivator.
And Juju, main surprises for you?
Look, I think for me, what was really exciting to see was a definite difference in the younger generation. So I would say that the foreshadowing is there's a change coming, so we see younger, and there's a bit of a call to arms as well, I think, for investors. Younger generations are not as knowledgeable about responsible investing, but they expect it more. They believe they outperform traditional funds more, and their savings future or their financial future is still ahead of them. So I think for investors taking on that responsibility, and for organizations like RIA and Mindful Money to educate the younger generation as well, and to provide options that speak to that generation. So they are different. They care about different things. We have a lot more detailing actually in the report about some of the issues that the different generations and by gender that people care about. So I would encourage those that are interested to actually access the report on the website, but also just to bear that in mind in terms of building products and what's coming. This is coming, and coming on really strong.
Brilliant, thank you, Juju. Perhaps not surprisingly, one of the first questions that's come in is relating to the conflict that's happening in Ukraine at the moment, and I might direct this to Simon initially. We've obviously seen a lot of organisations divesting in Russia following what's happened with the Ukraine conflict. In your view, how should responsible investors respond to what is a really complex governance and social risk like the one that invasion poses?
Yeah, thanks. It's a horrific live example for us, isn't it, really? And it kind of puts the sector under a test and under a microscope, I think. And what it shows is a few things. One is it really confirms that expectation, doesn't it, by our clients that we are not outside of what's going on in the world, and the way we invest is absolutely need to be considering the impacts of that and the flow through impacts of that. And so there is an absolutely clear expectation we've seen to avoid that, to divest, to move away. I think really importantly though, there's an expectation that as investors who sit there every day analysing the world, the geopolitics of the world, the risks, the ESG risks at a company level, that there's a sense that we need to be on the front foot around these things. We need to be preempting human rights disasters, conflict, as well as, climate change, risk, human rights, risk, all sorts of them. And so I think there's rightly so, an expectation that investors are proactive. And what it tells me, though, is it's not just at a stock specific level within a portfolio. They need to be really considering responsible and ethical investment as it applies across a portfolio, across asset classes, across sovereigns and companies through debt and fixed income investment. And really it sort of highlights that systemic nature of where responsible investment has arrived. And it's more than just divesting a stock. It's about thinking about the broad and complex systemic issues. We can't simply divest our way out of some of the world's greatest challenges, ESG, sustainability, and ethical challenges. We actually need to proactively try to shape them. And so I think it is a live and unfortunate example of the methods and tools we need to apply to be delivering for our members and the expectations of our clients out there. And it's pleasing to see a number have responded really quickly. Probably the criticism globally has been that why was there such exposure for some already in a country where there were so many signs of ESG risk, human rights breaches. And so I think that's something for us as a sector to really ponder and think about our role in the more systemic nature of the world and the geopolitics of the world as well.
Brilliant. Thank you, Simon. Either Juju or Barry, did you want to try and tackle that one as well?
Yeah, I'll pitch in on that one. Sort of when the conflict broke out, Mindful Money, we have a sort of a policy of transparency. We put up a listing of those funds that had investments in companies aligned with the Putin regime or investments in Russian sovereign bonds on our website. And we got a lot of interest from people, unsurprisingly. And at the end of September, there were over 100 funds that had investments in those Russian assets, and we tracked those as funds divested from Russia. But as Simon says, it does call into question why many funds didn't divest earlier. And if you've got tools like ESG tools, they're meant to be predictive. They're meant to be able to say, here are some risks going forward. It's not just meant to be kind of after the fact. It's meant to be anticipating the risk. So at what stage of the troop buildup around the Ukraine borders was there sufficient warning of risk so that funds should have divested? And it's not just a kind of an ethical and moral issue about financing Putin's regime. It's also an issue of financial risk. And those that didn't get out before the invasion lost most of their investment. And so we've seen the financial consequences, as well as the reputational damage, as well as the concerns over financing having helped basically finance the military effort in Ukraine. So in a way, it's no wonder that some people are concerned about ESG management if they see an issue like this where action isn't taken ahead of time, because that's what ESG is meant to do.
Yeah, brilliant. Thank you, Barry. Juju, was there anything else you wanted to add?
I think the only thing that I could add here, and this is not of the research, but an opinion, I guess, of the whole, what does responsible investing and ethical investing allows you to do? And what it allows you to do is to tackle ESG issues or non-financial or a broader set of issues than you normally would be looking at, I guess, in a traditional sense. So you would expect that those that are sort of leaders in responsible investment would be able to respond to these issues or avoid these issues and react quicker or perhaps anticipate some of these risks better.
Lovely, thanks, Juju. And while I've got you, Juju, I think one of the questions has come in, I guess, we've identified that there's also, as well as there being risks associated with all of this, there's also a lot of opportunity for fund managers and investors to create new products and to align those products with consumer values. What do you think are some of the barriers that are stopping that happening right now?
Well, look, I look back to our other research, the benchmark New Zealand survey, where we actually asked investment managers and asset owners that do investment management internally, what are some of the obstacles to responsible investment growth, et cetera. And they do say that consumer awareness is one of the top concern. And that is a bit puzzling, because that's really not, our results are saying that consumer awareness is actually high. So I don't know. I suspect maybe the distinction that I drew before between expectation and asking for it. So I don't think the consumer results suggest that people are expecting that this is already happening. So they're not necessarily going to knock on the door and ask for a quote responsible investment or ethical product, but they just expect that products are designed with that in mind, and that they're that they're aligned with those values. So or if the fact that they don't really know where that money is actually invested in. So yeah, I think there's a huge opportunity for to design products, not just for the general, or not just for the public in general, but to specialize. We see gender-based differences in some of the issues that people are concerned about. We see generational differences as well. Barry already talked about the animal products. So yes, there are some features or some issues that the population cares more about than others. And we don't really see products designed around those, or really focusing in or tackling, and just targeting some of those differences.
If I can, Dean, there's we've got a few kind of lag indicators and a few leading indicators that keeps me a little bit optimistic that this is being resolved slowly but surely right now. And the lag indicators, products take a while to come to market, and partly why we do this research is to get our members to understand what the market is demanding and looking for. So recently, of our certified products, we have about 230 products certified there. We've just recently achieved half of those New Zealand domiciled or New Zealand available products now. So there's been a big acceleration in availability of quality, responsible and ethical investment products in New Zealand. I think what we're starting to see in the lead indicators is a pipeline of products who are starting to speak to us through certification that are more thematic products, actually specializing in water or energy transition, or low carbon funds, sort of sustainable agriculture funds. And so it's really interesting to see some of these more thematic listed equities funds come into market. And I think part of the reason for this data is to sort of encourage them to bring that forward to really meet that demand. So there's a bit of a time lag here, but I think we will start seeing those come into market. And of course, there's some pioneers in the NZ market who've been doing really interesting, great stuff for a long time. So, hats off to them who've been leading in this space as well.
Yeah, I would agree with all of that. And I think there have been significant changes in the market and new offerings. And that being said, this is kind of consumer research. And if you look at consumer products companies, they kind of pore over the market research, and then they do what they see customers wanting. And I think Juju is exactly right, that in some areas we would expect there to be more client-focused products than are currently available. And so, it's almost a sort of a maturing of the market is starting to happen, as you say, Simon. But actually there's a fair way yet to go in order to meet those market expectations and market demands. And hopefully the information that we're putting out there as Mindful Money and RIA is helpful to fund managers who are looking at the next generation of their responsible investment products. And the good news is that there's room for everyone. There's a diversity of demands out there. And there's lots and lots of product segments which are not being catered for at the moment.
And just finally, there's a bit of incentive to those listening. When we monitor the funds under management under our certified products quite closely, and that's growing really rapidly. And we've seen some of those products in this space are seeing really astronomical inflows and growth rates when they're actually doing this right. And I would say, for those who are on the line, this research should be passed on to your marketing teams as well as you as the sort of ESG or responsible investment team. So it's really, really valuable research for you.
A few questions coming in around the level of consumer expectations. And so a couple of questions, which again, I'd throw out to any of you. There's certainly some relative differences in consumer expectations between the New Zealand consumers and Australian consumers, as we've surveyed them both. What do you think might be behind those differences? But probably more pertinent is what can we and those investors who are tuning into this do to help educate consumers, do we think?
Great questions, and Julia might have a view, but I noticed that because we recently released the Australian report, and awareness levels are about 20 percentage points lower in New Zealand than Australia. Sort of propensity or desire to invest ethically, again, about 20 percentage points or so lower in New Zealand than Australia. It's an interesting one. I mean, we are going on having observed this sector for the last almost 10 years, there's this sort of snowballing of awareness, right? And part of our jobs is to build that awareness and make sure we're getting out there and to make people know that there's choice in a market and there's such a thing as ethical and responsible products, and you can invest your KiwiSaver in these kinds of products. And so that's very much on sort of our shoulders to get out there and do that. And I think also there's this expectation by many that this is already being done as a matter of course in the way you bank your money and invest your money and put your money in KiwiSavers. And so that, as you just said this a couple of times, that people aren't going to come to you and say, I want the ethical option. But if they find out and look finally at their portfolio holdings and find a suite of highly unethical companies in their top 10 stocks, they're going to be furious. And so I don't think we should be waiting to actually hear the calls of demand from our consumers. We need to be acting proactively on that. Probably the only final thought is, in New Zealand, really insightfully from a government perspective, there's been some settings in the default structures in KiwiSaver to ensure a baseline of responsible investment is built into those default KiwiSaver products. And I think that becomes a floor, not a ceiling, but it kind of has ensured at least some activity is there by default, which is something that's absent in the Aussie market, for example. I'd welcome both your opinions, Julia and Barry, on that one.
I agree with that, Simon. Obviously, I don't know the Australian market as well as the New Zealand market. Those awareness figures, I think, have not grown significantly over recent years, and I think that more public education is required. We're often a little surprised that in terms of kind of the main institutions that provide public information about investment, that ethical investment doesn't feature often. So there was a Herald a supplement this morning all about a retail investment and saving for your retirement. In a 30-page supplement, there wasn't a single mention of ethical investment. And I think that's the kind of thing where RIA and Mindful Money are obviously out there trying to do this public education, and we're joined by some others. But in a way, some of the messages aren't necessarily coming from the mainstream media, aren't necessarily coming from the regulator, from the FMA, aren't necessarily coming from those who do financial literacy. And so, it is one of the things through that we're working with the Toitū Tahua, the Centre for Sustainable Finance, in order to do capability building around sustainable finance more broadly in New Zealand. So I think there's kind of a larger agenda around people's awareness raising on finance more generally, not only in terms of responsible and ethical investment, but actually around sustainable finance in its broader framework. So hopefully the investments that we're all making now will hopefully start to build that awareness over time.
Right. So my thoughts on this issue is, of course, we did this Australian study just recently, and we did see those differences. So looking at the two countries and the way that their financial their institutions are, so there are a lot of similarities between the two countries, Australia and New Zealand, in terms of their, not necessarily their size, but their, they're a very distinct market. There's a high level of regulation. The population is well off, and so forth and so forth. So there is that level of confidence. So I would look at the differences between the two countries when it comes to anything that could impact their financial awareness and responsible investment awareness as possible, reasons. And here I see, in Australia, which is what I'm more familiar with, is we see a government that hasn't really stepped in on climate change and a lot of key issues, whereas in New Zealand they have. So here, I think in Australia, people are just much more used to that the corporate sort of sector needs to act, and in the absence of government, then the individual needs to also look at that. So people are much more aware of those issues and the shortcomings of government, I guess, in response to that. Whereas I don't think that's the issue in New Zealand. Then we also have we also asked both in Australia and New Zealand how much savings people have, depending on, again, age and gender as well. So in Australia, generally people have more savings in their super fund, which is the equivalent of KiwiSaver, by, at any comparable stage. So there's a higher contribution, plus also I think the system has been around in Australia perhaps a bit longer. So people have grown up with this sense of, I have to, take care of my finances. And of course there's marketing, there's a lot of that in the media as well, that you need to take care of your finances and your future. The pension's quite low, and when you retire. So I think all of those things have contributed to Australians just being much more aware of their finances. And coupled with that, the inaction of government is probably what we're seeing in Australia. Whereas in New Zealand, I suspect that these kind of compounded in a way to, with a high trust that government's handling some of those issues. And in the report, when we asked about those specific issues, we did see that particularly issues around climate change weren't as important as in Australia. And I suspect that's because there is a general feeling that regulation is taking care of some of those issues, and you don't need to focus on investors to do that.
Thank you, Zsuzsa. We talked already quite a bit about expectations and how strong those expectations are. One of the findings that really jumped out to me was that 56% of respondents would consider actually moving their money if they found out their current fund invested in companies that engage in activities that are inconsistent with their values. Barry, I might go to you first, but from an investor's point of view, how can I use this research to inform product design and the engagement that I'm trying to do with consumers?
Well, I think starting with the study is a really good thing to do, because it does talk about the kind of issues that people want to avoid. It talks about the values, and as you probably know, one of the things that Mindful Money does is we track portfolio holdings by those issues. And so people can now go to Mindful Money website and they can see what's there. Now that transparency actually is driving quite a bit of change. We are seeing a lot of people go to our website and say, this isn't what I signed up for. I didn't sign up to invest in weapons companies and fossil fuel companies and gambling and so on. So we are seeing people taking exactly those decisions. And the survey results don't surprise me at all, because when people actually have the objective reality of what they are actually invested in, very often they'll be surprised. And they weren't told that when they signed up to their KiwiSaver or their retail investment fund. And so they are acting then to switch. And so we are seeing that behavior. And I think it is one of the areas where transparency can be really helpful, because for most people, the words all sound very similar. Most providers say they do ESG analysis and they are ethical and responsible and so on. And it's only really once you start looking at what they actually invest in do you see the objective reality of how those differences play out?
Juju, maybe can I ask you the same question around how people can use the research, but maybe in particular with a focus on financial advisors, or if you're a financial advisor who is dealing with consumers, how can they use the research to help them?
So we had a few questions on financial advisors and when and how people access and get financial advice. So I think one of the important things is that financial advisors are knowledgeable about responsible investment, are able to offer definitions, and if clients as they're able to define and explain what that means and what it is and what it isn't. And even in the broader sense around, is it about exclusions or what sort of products are out there and what they're able to do. The other is, of course, knowing which products are certified or independently labeled. And also what that certification or labeling means. Okay, so we have at RIA, we have a certification scheme that has its own process. But there are, others as well, and other ways you can find out what is actually contained and what the different products are offering. And there are, of course, the different types of products. So I think those two are fundamental expectations of clients. Other than that, I think, a progressive education, or actually asking. So people want financial advisors to ask about their values or to consider their values and to take that into account. So obviously they go to the financial advisor because they have financial issues or they want to see growth or whatever. But on top of that, to ask more personally about what is important for them, and not just as a financial outcome, but perhaps as a real world outcome of some of their financial decisions and choices.
Brilliant. Thank you, Juju. Simon, I might kick over to you. There's obviously been a lot of talk in this, and there often is, around exclusions and what that means and what it looks like. One question is, how do we as investors and those working in the industry encourage consumers to actually go beyond that and beyond just removing things and look at some of the stewardship questions and a lot of the ways that we can work and have influence through investment?
Yeah, thanks, Dean. I guess when I see some of those slides, and I imagine many in the audience too, and see this long shopping list of issues that consumers care deeply about. And they're framed in a way as, do you want to avoid activities that create lots of harms? And it wouldn't take long for a portfolio manager watching this to say, well, that really limits my portfolio. And I guess we're at a stage in the sophistication of this sector where the power of capital and the power of investment comes from what you don't invest in, but equally it comes from what you do invest in and what you do with that investment when it's invested there. And so I do think we're seeing this sort of next shift and focus for us all, which is really what we're doing when we invest in a company, when we own a company, how we responsibly actually take the responsibility to shift the sustainability behaviors of that company. And the only way we're going to deal with climate change is by where we direct capital. The only way we're going to stamp out human rights in supply chains is by how we put pressure on companies who have responsibilities for those supply chains. And I think that is something that we're way less progressed at being able to articulate and being able to really clearly talk to clients about what we're doing when we talk about engagement and voting and stewardship and active ownership. And it's an area we're focusing on a lot at the moment. Our CERT program dives really deep on this to really understand what are we doing with the power of the capital that we responsibly manage. And it does go beyond exclusions. And it's not hard to pick up a portfolio of any fund and say, there's a company I really don't like in that portfolio. But that's not the end point. It may be that investor is holding that company and voting against directors or voting in support of climate change resolutions or calling that company to task to improve the way it uses water in its agricultural operations. So there's a lot we can do as a sector in terms of flexing that ownership muscle to improve outcomes in these really critical issues. And so I would say, let's not purely simplify the results here down to we must exclude every sector that every consumer has said they care deeply about. it really says that as an investor, we need to have a considered response for how we're looking at human rights risks, labour violations risks, all those issues that we saw there, animal welfare, animal rights. And so I think that's something that as a sector, we need to get better at articulating and disclosing. And we require that now through certification, is a disclosure and transparency on our stewardship activities, our voting activities and engagement. And I think that's becoming really important for us to be able to talk about that. And the practices to date, to be frank, are really poor generally in our sector. We're really not very good at it, but we're going to need to learn and move on that pretty quickly. So we're doing a lot of work with our members on that.
I think that's a really, really good point. And there is some good practice out there on the engagement. And you've seen, for example, a New Zealand Super Fund that organised a collaborative engagement on Facebook and others after the Christchurch shootings. They then did an evaluation of how that engagement worked and where they were able to make progress and where they weren't. And that kind of outcome-oriented approach to engagement is really important, because for the public, if they see a fund investing in a company that they really have problems with, in a way, it's then beholden on the fund manager to say, well, this is why we're holding this, and here's the changes that we're able to make to these and other companies through our engagement and stewardship activity. And I think it is one of the things around greenwash. People are looking for outcome-oriented measures, not just we had a few meetings with their board and then went away again, but actually we're able to move the companies that we're invested in towards the kind of social and environmental behavior which would be acceptable to the investors. And we're just starting to see some of that stewardship reporting now coming on. And I think it's really an important and rich area. And hopefully we'll see a lot more of it, because I think it's really important to build that trust that when funds say we're engaging, we're practicing active stewardship, that actually there's some result to that. And some things are confidential, but often there are things that can be talked about and even on a case study basis can give confidence to consumers that this is actually real and it's happening.
Can I just, I know we're wrapping up and we're just getting to the juicy stuff, but two things. So when we asked this question around exclusions in the survey, we did ask not just for sector, but company activities. So company activities are sector. So it's not always about exclusion of sector, just the activities that certain companies are known to engage and be doing. The second is that it would be really great if we could see investors not being reactive, but proactive. So not waiting for disasters or massacres of that magnitude but actually seek out. And I think this is what consumers would like to see, that proactivity in that engagement.
Brilliant, thank you guys. And I think you hit the nail on the head there, Zsuzsa. It sort of brings us to a close just at a time when things are getting juicy, but certainly a lot to digest. And want to thank you for such an insightful discussion, and also congratulate you again and the team on such an extensive report. I'm sure that everybody watching would join me in thanking Simon O'Connor, Barry Coates and Zsuzsa van Helma Zakar, as well as Carly Hammond, Olive Coulson, Katie Braid, and Estelle Parker for their work in pulling the report together. Finally, for those of you who haven't already done so, just a quick reminder that before we go, to make sure that you've registered for RIA's annual RI conference. After a false start, unfortunately, due to COVID earlier in the year, we're now locked in for the 28th of September in Auckland, and early bird registrations are still running, as well as some fantastic sessions. I certainly know I'll be particularly looking forward to actually seeing everybody face to face again, and being part of a group. And having just completed one in Sydney, it was fantastic to see everybody together again. So look, that wraps us up for today. A quick reminder that a recording of this event will be emailed to you this afternoon, along with links to the report, which you should have all received this morning, which is also available on RIA's website, as well as Mindful Money website as well. Have a fantastic rest of the day. Haere rā.